Okay, question and answer time from Sunday's Market Outlook. And I think I got my alignment wrong. I got just a little bit of white space here to write on, but we're going to live with it. Let's see. Is it possible to add 2-hour detailed seminar on repo markets in the applied series? Yeah, I could do that. I'm not sure 2 hours would be enough, because to really understand the repo market, we do have to start understanding reserves and excess reserves and the role that that plays. But yeah, I can add some parts of it over time, but it'd be about a 2 or 3 part series, but I can do that. It's hard to do the repo market on its own, because it starts getting, when you go down one pathway, it's like, well, I better explain this, and then you get someplace and you say, well, I better explain what this means now, so that you have a whole view of it. But yeah, sounds like fun. Passed CFA level 2 today. Well, congratulations. Marking the team who got me through level 1 and 2. First time of asking, I can't praise and thank them enough. Okay, that's a comment. And from Edmonton, past level 1 and level 2, thanks to your knowledge. I've been trying to break in a financial analyst corporate finance role for the past year from retail banking, RBC and TD for 3 years total. So in level 3, I'd like to get some experience first. Well, I kind of agree with that, because you cannot get the letters, and in the end, that's it. You got to get the letters, right? So you've passed level 2. You cannot get the letters until you have the 3 years work experience. So there's no rush to getting level 3 done, the exam done, unless you have this, because you can't get the letters until you have this anyway. So I'm okay with that. I've been doing valuation modeling in Excel after work to compensate for lack of experience, just watching YouTube videos, learning formulas, practicing different models. Would you recommend any paid Excel sources? Not really. Would you consider doing an Excel course yourself? Not really. There's lots of Excel courses out there. I don't know that I would have any advantage over probably searching YouTube and finding a bunch of good Excel courses already. Excel is a tool. It would be like saying, I want to learn how to be a carpenter. Are there any good saw courses where I could learn how to saw? Sawing is just a tool, right? So I don't know that I would throw myself too much into Excel. What else in your experience can I do to improve my chances in landing a role in financial analyst? I usually apply on LinkedIn, Indeed, or company's website. Social capital. A lot of times it comes down to who you know. You have you're in Edmonton. I wonder if there is a CFA society in Edmonton. I know there is in Calgary. I'm not sure if there is a CFA society in Edmonton. If there is, consider joining that. It often comes down to who you know and who knows you, right? Kindly consider creating videos with the applied series focusing on fundamentals and trading strategies for various commodities and energy futures. I did do some of that stuff as far as trading strategies go. But I think what you mean is like oil or gold or silver, which requires a deep understanding of each of the markets. I could add some of that over time, sure. The grains, I pretty much know the grains. I was going to add some stuff on the grains, but they get so big, it's where do you stop? What do we got? Can you do 2, 3, or 4 hour seminar about repo markets and basis trade? The basis trade I've already done. It's already in there. It's in the applied options under the futures and options on futures. Basis trade is in there. But yeah, I can do more repo stuff for the applied series. I'm from a non-English speaking country, but I find that finance understanding so interesting. Now I'm learning your free CFA 2018 level 1. Good. What have you found the most effective way to learn a new industry from scratch? Where would you start? Reading company 10Ks? Yes, I would. The 10K is packed full of information and new words you've never seen before. So every time you hit a new word or a new term you're not familiar with, you Google it. And you keep reading after, and then you Google it, and then you Google it, and you just keep going until you understand everything. Industry associations. Every industry has an industry association. Lots of good information there. 2 questions. Do you see 6 to 7 cuts firmly priced in, or as a probability weighted average of scenarios that could happen? Well, I'm just reading those probabilities off the Fed funds futures. CME provides the probabilities based on where the CMA futures are trading. For example, 500 basis point cuts in a recession has a 60% probability. 75 basis point cuts in a soft landing, 35%. Oh no, that's not how they do the probabilities. They're calculated based on where the value of the futures, Fed funds futures, are. Why do you think, unless that's not what you're asking, just made up the numbers as an example, point being that it's not too crazy that 6-7 cuts are priced in. This week I don't think agreed too much with it. TLT took a big dump on Tuesday. Didn't have a very good Wednesday either. Why do you think XLU fell this week? Because XLU is going to be priced like a bond, because it's utilities, right? Yields up, prices down. Last week in your weekly Q&A, you talked about rings of risk and focusing your time on one sector to learn specialized knowledge. Expanding on that thought, if you were to focus your time on a niche sub-industry, crude stocks, could you still achieve solid returns in the long run by having such a narrow focus? Well, you can, because there's opportunity everywhere. If, either they're going to go up or they're going to go down, is one way to think about it in an absolute term, or they're going to outperform or underperform the S&P. So that sets up potential trades. Also, the use of options as well to generate income from stocks you believe are priced so low they can't possibly go lower, or some that have no further upside than where they happen to be. I think that if you got to know a handful of stocks really, really well, you could still do very, very good, because there's always an opportunity. Because believe it or not, there are 4 positions you can take in a stock. Most people think, well, there's only bullish and bearish. No, there is bullish and there is not bullish. That does not mean bearish. It just means you're not bullish. And then there's bearish, right? And then there's not bearish, which does not mean you're bullish. It just means you're not bearish. So bullish, bearish, not bullish, right? It's just not going up, and not bearish, right? It's not going down, but it's not going up. You're not bullish, but you're not bearish. You're not bearish, right? So there are 4 positions. The not bullish and not bearish are excellent positions for generating revenue with theta. That is a good options play there. These are directional, so that is a good way to play the options if you're playing delta. So theta plays, delta plays. Let's see. What's the difference between SOMA and Fed's balance sheet? The SOMA is on the Fed's balance sheet. The SOMA was for QE only. So when they did quantitative easing, all the securities they bought went into a category called the SOMA, and that is where balance sheet runoff is happening. But the Fed has a balance sheet. We think about it in terms of assets and liabilities. Liabilities are reserves, right? And it has assets. It has to have assets if it has liabilities. It has to have assets. So what are some typical assets you would expect to have? Securities holdings. It generally has securities holdings, which it needs if it has to conduct open market operations. It has credit facilities. It makes loans to banks. So there's always some operational need for assets and liabilities on a bank's balance sheet, but the SOMA was just the incremental increase in the balance sheet as a result of quantitative easing. Short addendum to the telecom industry course about Canadian telecoms, covering main differences with the U.S. industry. Interesting to know how population and geography affect the Canadian industry. There would be, I think in Canada, it would be more expensive than the U.S. No matter what service you were getting would be more expensive because you have more geography to cover but fewer people to cover the bill. So the network, renting the network has to be profitable, otherwise you're not going to get a network. It has to be profitable, which means everything's going to be more expensive per user than it is in the US, which we see. So if we wonder why we're paying some, I say we because I'm not in Canada anymore, but I still, after 57 years of saying we, you just don't stop. Canadians pay some of the highest rates for internet access and wireless access in the world. Because of geography, because of the the cost of the network, and fewer people for that network. But if Trudeau has his way, one thing he will give us is a larger population, which the telcos can then spread the cost of the network over. So by default, we might get lower telecom rates, lower internet rates, as one positive that you can look forward to in that, I think. But other than that, it would be the same. It's an asset-heavy business with a lot of debt. And every technology cycle is about 10 years before you have to upgrade to the next technology cycle. And as you upgrade from each technology cycle, you need denser and denser and denser populations to justify the cost of doing it, which means they tend to congregate in larger cities first. It's expensive to roll it out to smaller cities, really expensive. How much worse would the banking industry be had the Fed never initiated the Bank Term Funding Program back in March? Well, I don't know that we could say that the banking industry would have been much worse. There would have been a spillover effect because you would have had fire sales, you would have had asset sales. You would have, and that would have affected a whole bunch of other assets because you would have driven yields up. The Fed would have had to have done something somewhere else. So, think about it like a river, right? And you're standing on the bank of the river and you're seeing people, help. Another person, let me see if I could draw the arms up in the air, help. People you can't see the rest of their body. It's underwater here. These are their arms up in the air. It's art, man. It's interpretive. That's the way you have to look at it. And you can fish these people out of the river. Or you could do what the Fed did, is go upstream and stop this person up here from pushing people into the river. And that's what that thing was meant to do, was to stop it from going any further than there. So whenever you have a problem, you can solve it more efficiently and more effectively by going as far upstream as you can and not dealing with the symptoms of it, but actually hitting the problem. Is this the first time the Fed has run a program like this? Oh God, no. Or were there similar ones in the past? Seems like quite the bailout. It wasn't really that much of a bailout. What it was saying is that here's an alternative to what you have to do, and for many of them, knowing that an alternative existed stopped them from, many of them didn't show up to borrow any money. It just stopped them from having a run on their bank potentially and then having to sell it. It just slowed everything down, right? So if you have a potentially unruly room of people, all you need to calm everything down is a man with a gun. They don't actually have to fire the gun, just the presence of it may calm people down. Well, it's a big bazooka that the Fed has, and sometimes all it has to do is back up the bazooka to the battlefield and everyone calms down, says, oh, okay, hang on, we're good. So there wasn't a lot of uptake in it for very long. I mean, there was some uptake, but then it sort of just went away. It just sort of went away. So that's the important thing, right? Looking into the newly launched, those that shall not be named, the Bitcoin ETFs, got confused between net assets of an ETF and holdings of the ETF. I noticed a huge discrepancy between the two for some of the ETFs. I figured out that net assets equal outstanding share times net asset value per share, I think you mean. Outstanding shares times net asset value per share. That would be the net asset, well, the NAV, right? Net asset value. NAV is what the ETF is worth if it had to liquidate everything and give everybody their money back. That would be, without market impact or transaction costs. That's the assumption of what each share is worth. Holdings equals shares. Well, in this case, holdings would equal the number of Bitcoin that they happen to have. Can you explain the difference? Well, unless they're using leverage. I'm not familiar with the ETF. I haven't looked at any of these ETFs at all, so I couldn't tell you where that difference would come from. But some ETFs that use leverage will have a difference between the assets that they hold and the net asset value. The net asset value is subtracting everything else that you got to pay for first. Whatever's left over belongs to the shareholders or to the holders of shares. Why are we using 10-year treasury and 30-year fixed mortgage? 10-year treasury is a bullet bond, which means coupon, bullet payment. 30-year MBA, 30-year fixed rate mortgage is amortizing, which means it does this, and 30 years is worth zero. So it turns out that the duration of a 10-year is roughly equal to the duration of a 30-year amortizing mortgage. Since they have the same duration, the 10-year is a natural hedging instrument. If you did 2-hour seminar on the basis trade and repo market, that would be amazing. Did the basis trade, but yeah, I can do repo in the applied series. I can do that. Have a sip of coffee here. Can you walk us through how you follow news? I don't think that I follow it any differently than anyone else does. There are certain sources that I prefer over other sources. Barron's, Wall Street Journal, Reuters, I prefer over other sources. Google and Apple News does a good job of learning how you navigate and learning what you look at and giving you that kind of stuff. So you have to understand that these things have algorithms. Well, you can use that algorithm to your advantage by not clicking on senseless stuff, right? Otherwise, you're going to get senseless stuff. But if you're very selective on the things you click on, you will get more like that rather than trying to find where everything is. Same with YouTube. If you are clicking on everything and all the clickbait and everything, then your feed gets full of all this stuff that's meaningless to you. So if you end up being more careful about what you click on, you eventually train the algorithm to give you what you want, to give you what you're looking for. So I don't know that I have any particular pattern that I follow. For the stocks that I follow, you just go to Interactive Brokers, you click on the stock, and you click on news, and you get a whole bunch of headlines. If I'm interested in the company, I've already left my email address with Investor Relations on their site, so I'm getting everything that's posted when it's posted, if it comes from the company itself. You can also put alerts on Google for, General Motors, Freeport-McMoRan, for whatever company you're looking for. You can put an alert on Google that whenever anything hits Google or it's mentioned in anything in Google, you'll get a notification that something new has just shown up. So it's there's a lot of places where you can just let them tell you, right? How do you keep a large class of students engaged when teaching a finance economics course? You got to make it real. You can't be textbook. Okay, you have to bring the real world in. You got to use companies that are in their zeitgeist. So you got to talk about Netflix. You got to talk about Meta. You got to talk about Google. You got to talk about what's going on with this, with that. You got to try to bring it to the real world as much as you possibly can. And as far as economics, you got to try to bring it to their life and the decisions that they make, that they may not realize that their decisions, and some of the decisions are consistent with economic theory, that once they have the words to describe how they're thinking, they may say, that's exactly what I'm doing. I just never thought of it. But that is exactly how I do it. Or yeah, that matches how I think. Or, oh, I understand why people do that now. So you have to try to, well, you got to make it interesting. I guess that's the only thing that I can say, is you have to make it interesting. One way that I have found that makes things interesting is you make it simple. Now you may say, but some things are complex. Yeah, but that's your job. You're the teacher. You have to find a way to describe it in such a way that after they hear it, they go, that's it? Because nothing is more addicting than success. Nothing is more addicting than learning something and feeling good about learning it, going, I get it. That's so addicting. And that's what you got to get. The other thing you have to keep in mind is you have a distribution of students in your class. Some of them are not going to come along for the ride. It's okay to let them go. There are people in your class for all sorts of reasons, and there's going to be 30 to 40% of your students who just want to get by. They're not there to shine. They're not there to grow. They just want to get by. You have to leave them free to make their own decisions about how they want to do things, which means you're not going to save everyone. Some of them you're not going to be able to reach, and that's okay. Some people are happy being a C student, and you have to let them be a C student. So, you teach to the middle part of the curve, which is a sort of, a common saying is that, you teach to the middle of the curve while always engaging the top end of the curve or the right end of the curve. But, your level of difficulty will be to the middle, which means you're teaching for a B or a mid B, but you're engaging the right side of the distribution and the left side. If they come along for the ride, that's fine, but mostly they'll opt not to. And that's about the best you can hope for. Not everybody sitting in your class is interested in learning. Some of them are just interested in getting the grade, getting the credit, and getting the degree, and that's it. They're not going to put in the effort. Let's see. If I understood correctly, RRP 600 billion, and when this is zero, the problem becomes, where does the Fed obtain money to pay for the repos? No, it's not so much where the Fed obtains money. It's once that goes to zero, the money market funds are usually a very large supplier of cash into the repo markets. That once it gets down to zero, the thinking is, well, they found securities to put their money in. Now they do engage in lending their cash in tri-party repos with other counterparties without the Fed sitting in between. But once they start to disappear as a supplier of cash, how does a bank finance its inventory of securities? It has to finance fewer securities. How do hedge funds get their source of money? And if they don't get their source of money, they're going to have to buy fewer securities. So you can get a problem where the collateral becomes questionable, because if there is less cash transactions going on, there'll be more volatility in spreads, which means a 2% haircut's not going to be enough. Maybe some people will withdraw from the repo market altogether because the collateral can't be trusted for more than a day, especially general collateral. General collateral could be anything. The specific collateral at least names specific bonds, but general collateral can be almost anything, including duration. including a 10-year for an overnight. Well, not if it's volatile, right? So it has the potential, when the cash suppliers dry up, it has the potential to cause a whole bunch of disruptions and dislocations. And if banks have to start using their own cash for their inventory, there go the reserves, there go excess reserves. And the central bank relies on excess reserves and ample reserves regime to set policy. Because if they go back to a scarce regime, then they have to engage in a whole bunch of open market operations to target their interest rate. Right now they don't have to because they target reserves, as opposed to worrying about a whole bunch of open market operations. So it just ends up being a whole bunch of work for everybody involved, and higher costs for everybody involved. So, once it gets to zero, then we have to start asking the question, is the amount of cash that will be supplied into the repo market going to contract? And if it is, then reserves are going to have to contract, because somebody's going to have to hold inventory without having financing, right? If it comes to zero, then there's no rates of... Oh, okay, I already answered that. Now imagine your portfolio, you are currently only having USO. Would you consider to open a position in TLT? I don't know. That requires me to know something about what you're doing, what your strategy is, what you want to open a position in TLT for, how long your investment horizon is, how much of a position. Like, there's so many questions I would have to know the answer to first, just to say, yeah, sure, I know nothing about you. I'd say if all you have is USO and you have a very concentrated position in oil, then yeah, you could do with some diversification, most definitely. Trying to construct a portfolio, but it's hard to obtain a long-term view with this market. No, it's not. It's hard to construct a short-term view with this market, but it's easy to construct a long-term view. Sometime in the next 10 years, this market will be much higher. Sometime in the next 2 years, bond prices will be much higher. Sometime in the next 2-3 years, the US dollar will be much lower. I mean, those things I know. When? I don't know. Beats me. So if you have a long-term view, buy the market. You'll be okay. If you have a short-term view, I don't know, flip a coin. You should be frustrated on a short-term view. For example, Canadian apartment REITs, buy them. Buy them. They didn't have a good week this week, but that doesn't change the fundamental story long-term. You buy them if you have a long-term view. If you say, well, I'm trying to make money over the next month, I got no clue where the apartment REITs are going to go. Over the next month, not a clue. They could go up, they could go down, but over the long term, they're going up. As simple as that, they're going up. The fundamentals of the Canadian housing market support it. So I think you meant it's hard to obtain a short-term view. I think it's clear that something is going to break at some point. Wouldn't you agree? Something always breaks at some point. With the escalation going on in the Middle East, and now with Pakistan having some problems with Iran, that thing is moving more and more towards escalation and not de-escalation. So, sometimes it's an event, a single event at a point in time that tips the scales, and then all hell breaks loose. Right? World War II was started with an assassination. It was that little thing, that tipping event that caused, that set the wheels in motion. That if you try to find World War I's cause, you trace it back to Archduke Ferdinand, and it was that silly little bombing thing. So sometimes it's just an event that in a moment you don't think much of, but it starts in motion, a direction that ends up getting weight of its own. Trying to construct a port. Okay, I already did that. If the CAD CPI comes in higher than expected, which it did, isn't that a bad thing for the CAD? No, because rates will be higher for longer. Currencies are based on interest rate differentials. So if we are expecting a stronger CAD, as long as we have no market stress, a higher CPI would indicate that the Bank of Canada would hold for longer, which would be supportive of the Canadian dollar. If interest rates are cut, that too is bad. That would be bad for the CAD. Yeah. If interest rates are cut. Just passed level 2. Great. Would love some advice on if I should sign up for level 3 in August or wait for the updated specialization material. I don't know. I mean, I haven't even seen the new material yet. I think it's about a month and a half away from seeing it. I don't know. Even if you write in August, once you have the 3 letters, once you're a charter holder, I believe you'll have access to these at some future point anyways. So I don't know that it's worth waiting for them. I've seen some mainstream media news sources discussing how the dollar is getting weaker. However, when I review the real broad dollar index using Fred data, the dollar is in fact relatively high compared to the past. Compared to the past, when they say it's getting weaker, I think they mean relatively over the last year. Specifically 2006 onwards, it seems the dollar index loses value as the Fed rate is relatively higher and then rises again once the Fed rates are becoming cut. No, because it's when the Fed is cutting rates, it's usually because there's a recession. When there's a recession, there's a flight to quality. The US dollar usually gets a bid, making it look like it's the lowering interest rate that's raising the US dollar, but it's a spurious correlation. They're both related to stress in the economy. Using high-level viewpoint perspective, may you review the main major factor component that affect? The main major factor. I mean, there's so many of them. It's a currency. Here's how you can determine what's going to happen. Flip a coin. It's just as good as any forecasting model out there. Flip a coin. That's it. Currencies are random walks. They are purely random. Sometimes they have a drift component, but for the most part, they're random. Where is it going to go? I don't know. Flip a coin. That is currencies. Could you please recommend a book that starts from beginner level and then goes to these advanced levels on the topic of Fed, RRP, and SOFR? CFA, level 1, 2, and 3. Lots of good books there. You mentioned that the yield curve is uninverting, and this occurs before entering a recession. So if you look at the curve inversion and you plot it against recessions, it uninverts before the recession, but the recession is not dated until 2 years after it happens, thereby giving the illusion that it uninverts during the recession when it may be uninverting during the recession, but that the recession isn't dated till a couple years later, and you realize that, oh, okay, it wasn't this date, it was that date. But in the moment, it feels like it's the recession. Is it not possible that some market participants are pricing this contingency in? Would this not explain the steeper Fed funds price term structure? Yeah, I mean, you could look at the rate cuts, and enough market participants may be saying, well, the Fed is saying 3, but they'll have no choice. They'll have no choice. The economy will force their hand. Yeah, that is a viable explanation. Any value to the retail trader in using any of the following: strategy, backtesting, Monte Carlo simulation, calculating risk or not really. Not for the retail trader. Strategy, backtesting, maybe. I notice you haven't mentioned any of the above. It's just not needed. I've never done a Monte Carlo simulation other than outside an academic exercise. I've never done a Monte Carlo simulation in real life. It's all built on a mountain of assumptions. I mean, it's all just a mountain of assumptions. Everything in that Monte Carlo simulation only does what you tell it. If you say this variable is distributed this way with this volatility, the simulator says, okay, I'll give you outcomes that look like that, but I mean, it's all built on a mountain of assumptions. That's all it is. So no, I've never used it. I don't see why a retail trader or a retail investor would invest that much time and energy in generating a guess when you could just guess, you know. Let's see. Pros and cons of strategy to borrow with IBKR on margin based on current rates. It's going to be high. It's going to be expensive. Invested in U.S. Treasuries, you'll lose money with over 20-year duration. Well, you're going to lose money on the yield. Guaranteed you're going to lose money on the yield. So what you're hoping for with this leveraged bet is that duration really pays off. And it has to pay off because it is a levered bet in which your funding costs are more than the yield on the asset you're buying. In which levels of yields and ratio management, margin, excess liquidity would you feel comfortable to execute? I wouldn't do it. If you want leverage, use futures. Futures have embedded leverage, and you'll have the negative carry, but it'll be cheaper than the margin interest that you would pay. All right, just use futures. If you're making a duration bet like that and you want to lever up, you can use synthetic options, or you can use futures. They already have embedded leverage without it costing you more than the 3-month rate. How's that sound? With futures, your funding costs are 3-month SOFR rates. With IB, it is probably the 3-month Treasury plus 150 basis points above that. So you'd be paying almost 7% interest. Oof, that's a huge negative carry. You mentioned a few times your skepticism about short reports from the likes of Viceroy. Well, I'm not skeptical about short reports. I'm just skeptical about companies like Viceroy, where the individuals have an extremely low level of education, and right from being from Australia and England, very English-speaking countries, to have such poor grammar is a sign of very poor education. So I'm skeptical of a group of punks that write the way they write and have a history of being paid by hedge funds to write hit reports for no other reason than to push the price of the stock down, but that they're not serious. They're just scumbags. So I'm skeptical of scumbags. I think that's a true statement. Just hear more of your thoughts on this particular topic. At least from the EU side, they have tended to be accurate. What evidence do you have that they have tended to be accurate on the likes of on one thing that they piled in on at the request of a hedge fund? So it's not as if they figured it out. It's a hedge fund figured it out. But you have to have, if you're going to run this kind of short and distort thing, you have to do it. If you're a fund, you got to have somebody on the outside doing it for you, so it looks independent because you have a vested interest. It's got to be somebody on the outside, so you feed them the information that they need. So, no. As far as they have tended to be accurate enough, what does that mean, accurate enough? And what do you mean by they have tended to be? No. Geopolitical risk could become much more relevant this year with regards to the energy market in light of the ongoing wars. I too believe that, and have entered into a moderately bullish option position on an energy index. Have you taken any position? No, I'm sort of still on hold right now until the 18th. Have you been looking into investing in any Canadian residential REITs? Cap REIT is the only one that I would look at. I'm waiting for a pullback below 45 before I jump in again. I got in at below 41, got out above 51, all within, I think, 7 weeks. It was a beautiful payoff in both my TFSA and RSP. Like, you just don't make that kind of money that fast in long-only accounts. It was beautiful, so I took it. And now it's pulled back. If I see it below 45, another couple of ugly days this week, maybe it could end Friday somewhere around 43. Wouldn't that be nice at 43, 42? I would load up on it again. Yep. What would be a potential exogenous risk of taking such a position? In Canada? A massive building of multi-unit structures, of multi-unit residential buildings. I mean, like hundreds and hundreds and hundreds and hundreds of rental apartments coming online in the next year. Thousands of them. I don't see that happening. Not really related to the update. Love to hear your thoughts on Queen's University. It's not just Queen's, by the way. It's not just Queen's University. They're the only ones that are probably being public about it. I want you to think about Laurentian University a couple of years ago. And there are a bunch of other universities as well. And whenever you have a constrained optimization, something has to give. So a constrained optimization is to say that you have a number of variables and you want to optimize the outcome, but this variable can't be above this number, this variable can't be above this number. That's a constrained optimization. Something somewhere has to give when you have that kind of thing. So what does a university have? It has revenues and it has expenses. Well, its revenues are tuition, and it has domestic and international. Right, and its expenses are staff, faculty, and admin. That's really a simple model of a university. Well, the government instituted, the Ontario government in all of its stupid wisdom instituted a tuition freeze. Oh, let's make tuition more accessible. Let's freeze the tuition. Listen, there are no free lunches. Again, if you constrain an optimization, somebody somewhere has to pay for it. Somebody somewhere has to pay for it, because you can't just print money as a university. Somebody somewhere has to step up and pay the bill. So you have a tuition freeze, and I think there was like a 10% reduction in tuition and tuition freeze. And now we're talking the Liberal government trying to do something for housing, is saying, let's lower the amount of international students that we bring in. Well, international students pay a hell of a lot more than domestic students. Domestic students are taxpayer financed because the university gets government funding for every human in a seat, but not international. They pay full pop. So you want the international students in here because the tuition plus the government funding doesn't really cover the cost of the student. So you have a constrained revenue, but you have expenses that just keep going up because of inflation, number one. But more and more, we're pointing to administration. Administrations became bloated with this whole woke stuff. Because, of course, you have a university, and let's say it has 7 schools. You have the business school, engineering school, law school, social science, or the sciences. Let's say you have 7 schools. Well, they all are going to need diversity officers, right? You all have to have diversity officers in the most diverse place you can find in the world, which is a university campus, rampant with racism, right? So, but you need diversity officers, right? For the students coming in to make sure that the student body is diverse. But your faculty has to be diverse as well too, so you're going to have some kind of equity officers as well. So you got your diversity officers, you have your equity officers. Administrations became bloated with this DEI stuff. So you had expenses that were just increasing, inflation plus DEI, and you had revenues that were frozen or that had to be lowered by 10% for the last 4 years. Duh. This is what happens when we no longer care about the quality of the people we elect. We only care about the popularity of the people we elect. This is what you get. You get outcomes like this. Let's do everybody a favor and freeze tuition. Let's make sure that everybody's represented, and let's make sure we don't hire any more white professors. Well, you need people to monitor that. Every time you want to constrain something, you need bureaucracy. You need bureaucracy. And the bureaucracy grows and grows and grows, because if you're going to try to make sure that everyone has equal outcomes, you need to police that. You need more and more and more administrators. It shouldn't come as a surprise that universities are running out of money. It should not come as a surprise. And it's not just Queen's. It's a bunch of other universities that are close to the edge. They just haven't publicly said so. But there is a reckoning coming. And that reckoning is going to be a massive reduction in administration. It's going to have to be, and it's going to be a massive hike in tuition, or the taxpayer is going to have to pony up even more money. That's just the reality of it. Nothing is free. Now imagine if you took this scenario, this is just with a 10% reduction in the freeze. Imagine if you made it free. How many universities would be out of business if you made it free? Because who's going to pay for it, right? This is just a 10% reduction in a tuition freeze, and the government is not stepping up to fill in the gap. Who's going to pay for it if it was free, right? You can't make it free. Nothing is ever free. And if you want to find out how expensive something can really be, make it free. Make it free. This is not over. Queens is the tip of the iceberg. There are more, and it's going to come out in just a matter of time, because you can't continue on with those kind of costs, with that constraint on your revenue, and with the Liberal government now saying, well, we can fix the housing problem by limiting the amount of international students come in, when it's the international students that are the answer to the problem because they pay full pop. This is what happens when we elect imbeciles based on their popularity and not their qualifications. We as a population have abdicated our responsibility when it comes to politics. We vote our colors, we vote for popular people, and we no longer care about their resume. Well, you get the government you elect. So I'm not there anymore. This is not my mess. I don't have to pay for it. The other taxpayers that are left are going to have to pay for this, because somebody somewhere has to pay for this, period. And that's all it is. You mentioned in reverse repo section, the Fed would start considering tapering the balance sheet runoff to keep ample reserves. Assuming the Fed balance sheet consists mostly of treasuries and MBS, the taper would come from the treasury runoff. MBS portion of the balance sheet would not be affected by QT. They'd probably continue MBS runoff because they have too much of it anyways. So they'd probably consider keeping that going, but tapering the treasuries. And if they don't buy as many treasuries, then they can, right now, by reducing the amount of securities that are out there, or by introducing more and more of the securities, what is happening is there's more and more options to put money. If you taper that, then you are actually removing options for money to sit in, because the Fed is sitting in it, so no other money can sit in it, which means that money has to sit in the banking system somewhere. Money has to sit in the banking system somewhere. At all times, it must be in the banking system. Because it never just sits in cash. Somebody somewhere is going to use it. So yeah, it would stabilize. If excess reserves started dropping too fast, they would have to do something to level it off. And I think we look at their balance sheet. We'll look at it on Sunday. We'll look more at the liability side. I think they're somewhere around 3.3 trillion in reserves. And they mentioned that they would not allow it to get to 1.5, which is how far it got down last time in 2019 when they hit a problem. They wouldn't allow it to get to this number, so somewhere in between here is where they would stabilize the excess reserves. 8 FOMC meetings in 2024. 6-7 rate cuts means making a cut in every but one meeting. Yep. No cut in January, then it'd have to be a cut in every single meeting. That is what I had said in the market outlook. Do you think this scenario is a base case now? Well, it's the case that's priced into the Fed funds futures. Whether it's I don't think that's a base case, but it is what's in the Fed funds futures. Our market is discounting some kind of average of various scenarios. Yeah, 50% for 425 cuts, another 50 for recession, and 12 cuts in total. Could be. I mean, it's hard to infer what scenarios have been aggregated to create those probabilities. All we have is the probabilities. and what is priced in based on where Fed funds futures are. I have heard people talk about being short duration and long credit. What's your opinion on that for 2024? Most credit investors do isolate the credit spread. So if you are invested in credit, you have a yield that is made up of the risk-free rate plus a credit spread. So you're long these two components, and typically they'll isolate the credit spread by being short a pure treasury that is nothing but the risk-free rate, thereby canceling these out and then using leverage to lever up the spread. That is typically the way that credit portfolios are structured. Spreads are tight. Spreads are already tight. I don't know that I would be doing a leveraged spread trade or even an isolated spread trade on the credit spread. Spreads are tight. I know duration is big on your list of ideas. Curious how you feel about playing the off against each other strategy. Not really. No, I wouldn't be into that. Can you make a full ground up explanation video of the repo market? Quite a demand for this, right? Even as a finance professional, this is the area that makes me feel like a complete idiot because I can't understand it. Yeah, I can do that. Stop watching TV thanks to your excellent content. Okay, that's good, I think. If I sell naked call option on SPY, 1 month out, 500 strike, at the time of writing this comment, I would get a 50-cent credit, which comes to about a 6% annualized yield on the margin requirement of approximately 10,000. However, if I buy a call at the same expiration at a strike of 505 for SPY to create a credit spread, I would get a credit of around 25 cents. My margin requirement drops significantly to 500. Yep, that's true. Combination of lower requirement and high yield on that lower requirement makes it seem like it's too good to be true. Well, it's you got 25 cents, so you're getting $25 on 500 because you have a defined risk. Now you're doing this 1 month out, right? So assuming that you have a constant $500, that you're always going to target a 50-cent call and a $25 up, that you'll always continue to get that spread for 25. Keep in mind you have transaction costs on two legs, right? That you have to pay for, so you don't really have 25. If you consider that your I don't know, even at low prices, 70 cents, $1.40 in, $1.40 out, there's 280. You're really at 22.20. You have to consider your transaction costs, right? And if you can do that 12 times and win every time, yeah, you can do fairly well, because you'd multiply, even multiplying it by 10, you could see it comes to 222 over 500, which is approaching 50%. So another $44, $266 over 500. You're still well over 50% return if you win every single time. Keep in mind, if you lose on one of them, you lose $475 all at one time. If you lose on one of them, if it blows right through your spreads and you lose on one, a whole year is not, you're wiping out 2 years. You could have 2 years of wins, and if you're wrong just once and it blows through your spread, you lose it all. So it sounds like a high return because it does have a high level of risk. The repo market, yeah, okay. Can you do a biotech sector analysis? Yeah, I can. I don't know how interesting it would be, because it's every biotech is different. I mean, I could, but I don't know that is in my next 10 that I would think of doing. I think there are more exciting ones. Can you show us how hedge fund executes a basis trade step by step? That is in the applied series. Can you explain the mechanics a little more about hedge funds conduct basis trades using leverage? That is in the applied series. I think I even gave you the link for it, or not the link, but the steps, the menus that you would click on to get to it. How long on average does it take till the market bottoms? Like 2 quarters, 3 quarters? Oh, till the market bottoms. Oh, hang on now. I don't know. 2 to 3 quarters usually is before the start of the recession itself, and then the market. Yeah, I don't know. Beats me. I don't have the numbers on that. Is the market pricing in 31% probability of 3 rate cuts by June based on the need for the Fed to get back to QE given the situation? Well, that's a different thing altogether. No, it's just pricing in 3 rate cuts. Yeah. What do you think of Canada's negative economic outlook for the next couple of years? I think it's justified. I mean, if I had to pick U.S. or Canada, I'd pick U.S. in a heartbeat over Canada. Yeah. When you're leaving Canada, did you have to give up your Canadian passport? No. Even if you give it up, you never really give it up because you're always a Canadian citizen no matter what you do. You're always a Canadian citizen. Why would the SOFR rate go above the upper range set by the Fed in 2019? Because nobody wanted to lend to anybody. There was a level of perceived counterparty risk, and there was a shortage of cash. Powell sort of blamed a corporate tax payment that was due, but I don't think the market is that short-sighted that it would have forgotten completely about that. There was a shortage of cash to lend into the repo market. At the same time, there was an overabundance of treasuries being supplied to the market, not enough money to finance them. So if you needed financing, you started offering. Look, I'll pay 3%. Nope, I'll pay 3.5%. There's still not enough. There was just not enough cash for all the treasuries, so I'll pay 4. I'll pay 4.5. Right? So that kind of thing goes on because you got to balance your book by the end of the day, or you got to sell stuff. It's not even by the end of the day. I think there's like sometime in the afternoon if you're not set to go. That sometimes it's as early as 11 o'clock. That if you're not a counterparty to a repo by 11, you're not going to make it. Some are allowed later in the day. I think for more if you're doing tri-party, which means you're doing a tri-party repo. General collateral, if you can, again, you need suppliers of cash, right? If there's no suppliers of cash, rates got to go up. Valued ABR at 1550 using GGM. Do you think it's a good buy here? I haven't seen the price. I think it's under 14. No, not under 14. It's 14 and something, low 14s. I've always, for ABR, I mean, if you have it's going to respond to the interest rate. And I think there's this negative overhang about all the commercial real estate coming due this year. Sentiment will probably bring it down a bit more before earnings. They keep performing on earnings though. They just keep performing, but they just don't get any respect. I wish that would change, but they just don't get any respect. Still, I have them in my LIRA, my locked-in retirement account, and I'm sitting on excess cash right now because I sold the apartment rates. If they got down, if I saw them lose another couple of bucks this week on just the sell-off, I probably would pick some up, yeah. Holzman from ECB said that we shouldn't consider any cuts in Eurozone in 2024 because of geopolitical risk. Yeah, that has the problem to derail everything. Although, when you think about it, it's not global, right? I mean, it doesn't affect everything. There are ships going from China to the western seaboard, to western shores of the U.S. That's not being affected. Trade between Australia, India, New Zealand, China, Vietnam, all that's not really being affected. It's just if you got to go through the Suez Canal. But there's a way around it. You just go around the Cape, right? So it's not as if there is no inventory. There is. It's just going to take longer. And it's not the whole world. It's just that area. So I don't know. I don't think so. To say no rate cuts because of inflation and that we can go another year with rates this high in such a low growth environment in the euro area is wishful thinking, I think. But then again, the ECB only has one mandate: price stability. They do not have a full employment mandate. It's only price stability. So they don't have to run and prop up their other mandate like the Fed would have to. Difference between QT and Fed reverse repo facility. Yeah, they are different things altogether. One is temporary, one is permanent. So quantitative tightening is the selling of securities on a permanent basis, or at least the rolling off of securities on a permanent basis. Reverse repo and repos are temporary, overnight. Where a security leaves and then it comes right back, or a security shows up and then it leaves the next day. They're temporary. Should have made a stop on the way to CR and seen all the new build inventory standing empty and builders dropping prices and offering concessions. Well, that's not showing up in the home builder stock prices, so I'm going to go ahead and say it's not a thing. Or if it is a thing, it's not really a big thing, because it's just not showing up in the home builder prices or their earnings. Every time earnings, they beat their earnings, raise their guidance, and up they go. You recently said peso was second, peso was first. I think peso was the best performing. INR, best performing currency 2023. What's the best? Peso was second, INR was third. The best one, I think, was Brazil. Was the best one. Why do you include dividend yield in the estimation of S&P 500 level? Is an S&P 500 a price return index with dividend cutoff? Yeah, the S&P is a when you're looking at the price of it, it is just the price. The dividend would be removed from there. That's a good point. That's fair enough. If cash flows, if the cash flows from back to, okay, I'm not understanding those three words together. Because of high interest rates, MMF is also a cash provider for RRP, probably the biggest, about 80%. Why would liquidity dry up for RRP? Because there's more options to invest in other places, right? The Treasury, even 3-month Treasury yields are higher than the reverse repo rate. So money market funds would opt for where they should be, which is in money market funds. That's where they would be. Liquidity is still in the system, but just moved from bank to MMF. Not really. No. No. Any thoughts on the uranium sector? None at all. None at all. I'm just going to skip that one. I know you touch on Canada's current political situation. Full take on PP. I want to get your take on his proposed policies and perhaps dismantle them, and whether it's feasible or not. Well, first of all, he's a politician, okay? The question of if it's feasible or not, that's the wrong question to be asking from a politician, whether it's feasible or not. Most of the policies that any politician has are going to be very different than what happens when they get elected. So I don't even think it would be a discussion of whether it's feasible or not. To some degree, yes. To some degree, no. You could say that for everybody, for every party's platform. The big difference between the Conservatives and the other two parties is the Conservatives aren't blaming successful people, aren't demanding that successful people pay their fair share. They don't engage in rhetoric like that. They don't. The Conservatives have been, at least with Poilievre, have been very careful not to engage in identity politics either, by grouping you into a category based on superficial markers of your identity. They've sort of avoided that as well. You could sort of just say that they are I think well-needed break from the lack of common sense of the ideology that we've lived with for the last 5 or 6 years, the ridiculous ideology that we've lived with that have had nothing but negative, pretty much negative consequences. This idea that we shouldn't be stigmatizing drug use. First of all, there is no evidence whatsoever that whether you stigmatize or not stigmatize drug use, that they seek out treatment. There is no evidence for that whatsoever. None at all. It's just some kind of brainwashing ideology that makes people believe shit like that. It's just I think he represents a breath of fresh air in terms of a return finally to common sense, because there is a large majority of people who roll their eyes constantly internally at the ridiculous statements that come out of the left's mouth sometimes, but are just too afraid to say anything publicly because of their job, because of this, because of that, but would love nothing more than a return to some common sense. Yeah. He's proposing a full 180 on many issues, as if there aren't powers that influence certain outcomes. Speed up housing permit approvals. That's an easy one. Speed them up, absolutely. To me, when politicians starting to speak too much common sense, it's a red flag on its own. I don't know how to answer that one. Dante reference called anti-purgatory. In your thesis, you mentioned the Canadian government imports votes via immigration. How would increased immigration actually lead to votes? Well, you have more people. If they're permanent residents, they can vote. Hard to imagine individuals crossing the border having voting on their list of priority. Well, I mean, you're putting the cart before the horse. It's not as if somebody's saying, listen, we got to immigrate to Canada so we can vote. They're not saying that. It's like, we got to immigrate to Canada, and while they're here, congratulations, you're Canadian, you get to vote. Oh, that's nice. Voting was not their motivation for coming here. The ability to vote is the outcome of being here. So I don't think that anybody's heading here saying, I got to get to Canada to vote for Trudeau. I don't think anybody is saying that. It's just once they get here, they have the right to vote. What's your target price for TLT? I don't know that I have a target price for TLT as much as I would say a target rate on the Fed funds futures, which I think 3.5 makes sense. Quick summary video of your weekly outlook. Thoughts on Oxy Iron Condor? Haven't really thought about it, but I would not limit my upside in any way whatsoever. No, I wouldn't limit the upside. I just wouldn't mess with calls. Hey, Aswath, Jane had a better question. Why did they send Dominion my way first? No idea what that is. What is the rationale for the basis trade to even exist? Why futures prices and no arbitrage? You would have to understand the Treasury futures. The underlying is a generic is a specific bond, but the futures is on a generic bond. So because of the difference of the two, you cannot have a specific bond in a treasury contract. You can only have a generic bond, but some specific bond must be delivered to satisfy the generic bond. That sets up a whole bunch of optionality for the seller of the treasury, and optionality has value. So it will the what appears to be arbitrage is really just a payment for optionality. In the applied series, I do cover that, and that takes us through this week.